Good morning, ladies and gentlemen. My name is Jesus. I'm with the Hispanic Chamber of Commerce as a membership director. Today, we have a great meeting. Today, we're going to learn a little more about the economics of both the U.S. and Colorado. Today, this is an important conversation, and for that, we have the great support of the Federal Reserve. Today, we also have our president and CEO who is here with us, who's going to also introduce to us someone who's going to be key in this conversation today. Our president and CEO, Mike Ferrufino.
Hi, Jesus. Thank you very much. And I just want to say thank you for joining us. We're going to go through and make sure this is available in terms of streaming content from a number of different outlets, as well as send in our newsletter. And so we'll have this archived as well. So for anybody that wants to listen to it again. But today we've got a really special opportunity to be able to go to and talk with Dr. Nick Sly. Nick is a vice president, economist, and a branch executive at the Denver office of the Kansas City Federal Reserve. And so we're really going to go through and talk about a number of different things from high level, from lower level. But for a moment, I just want to go through and pull Nick up and introduce him and get him on screen.
Good morning.
Good morning, Nick. How are you today?
Doing quite well. I'm pleased to be able to be here with you all.
Well, thank you. Thank you. As we kind of go through and kind of begin this discussion, I think we have seen, the term unprecedented is almost cliche at this point. We don't have a handbook in terms of how a lot of things have worked. But as I remind sometimes our elected officials and decision makers, sometimes we have a handbook in terms of how things don't work. And so when we think about that, I'd love to get some insight in terms of overall kind of economic indicators and factors. I think we see a housing boom. I think there's questions about how long is this going to be sustainable. We also have, a challenge with employment and labor force, specifically in the hospitality industry, but warehouse, it's affecting supply chain. Part of it is kind of taking a look at exactly President Biden's different types of strategies in terms of tax plan. We're also looking at a interesting discussion about a first ever collaboration in terms of like almost an international minimum tax. Right. To be able to go through and start protecting and thinking about some standardization for our global economy at a state level. We have had structural problems with our Constitution, and despite, I think, being a state with a great amount of wealth, we have had some challenges being able to generate revenue. We right now are, I think, out of 50 states, we are dead last in teacher pay. We are 44 out of 50 in terms of being able to go through and provide dollars for public education for P through 12, and we are 49 out of 50 in terms of funding higher education. Now, it looks like with an infrastructure bill on the way, we're going to get some breathing room for a couple of years, but it overall doesn't necessarily kind of create the type of, let's say, revenue stability that we're going to need. Before the General Assembly session, we were behind funding transportation by $9 billion, right? Now we're able to kind of close the gap a little bit and find some different ways to be able to go through and do that. So I think when we think about what the prospects are, I think that maybe we can feel very confident, and it seems like there's a lot of confidence, but is there some underlying concern, and what is that concern? What should we be looking out for? What are these indicators that you are tracking? And then two, when you think about the Latino community, I first want to go through and qualify and say, that I will use the term Hispanic and Latino pretty interchangeably. And I understand that that is not the way everybody chooses to identify. Some people choose to identify as Latina, as Chicano, as Chicana, as Latinx, or some other terms. But nevertheless, I will use the term Hispanic and Latino as we kind of meander through this, just for ease of practice. But what I'm referring to in terms of Latino is the 62.5 million people that identify as Hispanic according to the census numbers. Now, those 62.5 million is a projection. We will look at what those numbers really are in the fall, but they represent an estimated $1.7 trillion in buying power. And the Latino Donor Collective did some research and determined what the GDP would be, if the United States Hispanic market was its own country. And it came out to $2.6 trillion, would make that the 8th largest economy in the world. Now, I think for a lot of people out there, these numbers may just be zeros, on the back of something. But I think the numbers that stick out to me is that just consumer buying power is bigger than the entire Canadian economy. And the United States Hispanic market, if it was a country, as its own, it would be the 8th largest economy in the world. Colorado is currently, the 8th most populated state in Hispanics in the country. And, and I think a really notable piece is that the Hispanic buying power in Colorado is $30 billion. And to give everybody a reference point, our state budget is about $34 billion. And the largest single industry in terms of economic impact, I believe, is oil and gas at about $30 billion. So this is really important for our city and state in terms of our short-term and also our long-term economic development. But there have been a lot of struggles, I think. You've had frontline workers, you've had a higher amount of infection rate, hospitalization rate, and death. We have very low vaccine uptake still. And we've got a lot of minority-owned businesses that, that I think that, the numbers I saw were 50% of Hispanic-owned businesses before COVID did not have a traditional banking relationship. So, so my first question is, if you were the administrator for the SBA, knowing what you know now, would you have designed PPP the way you did? And as we think through about, these different opportunities and challenges for the minority communities, minority business, what are some of those unique things that you've been hearing, you've been thinking about, or you've heard discussed? So it's kind of top level, what do things look like basically from this international kind of trickle, I don't like to use the term trickle down, but nevertheless, downstream effects. But then too, from this ground up effect of small business, understanding how critical small business is to the backbone of our economy. And when we talk about small business anymore, with 4.7 million Hispanic-owned small businesses in the country growing at a rate of 3 to 5 times the national average, we're talking about Hispanic-owned businesses, and so how do we make sure that they have everything they need? So with that, I'll stop talking and just want to thank you for your participation. Have you kind of go through, answer some questions, and go through the presentation, and we'll continue to basically go through and answer and have a conversation about this.
Well, Mike, I appreciate it, and thank you for the opportunity to come here and talk with you all. I like the way that you set up the larger conversation that we want to have, which is a breadth of issues. I think you're right that unprecedented is a cliche term, but cliches come from they're there for a reason, because I think they're reflecting the standard set of challenges that we're facing every single day. You laid out the variety of the issues that we have to face, and I would say one thing that's particularly unique about this time is that it's not just the number of challenges that we're all facing, and it's the equity issues that we all are focused on. For participation for real business, participation in the banking industry, participation in the labor force. I think those are things that we're often focused on, that we couch, okay, whether it's SBA programs and the PPP lending, whether it's economic stimulus payments or vaccine enrollment, whether it's the disproportionate presence of Latino and Hispanic individuals in Colorado relative to much of the rest of the country, are you seeing these communities able to participate in those recovery programs that we saw last year? And now that narrative is shifted a little bit to, as we're starting to see the economy pick up, and we're starting to see that private demand actually pick up, are we seeing an equitable and an even participation in that recovery? And I think so, despite the fact that we've got a number of different issues, whether or not it's the fiscal plan that's going to be coming out either from the federal or fiscal spending here at the state, whether it's the economic stimulus that comes from having monetary policy still being in an accommodative stance, having interest rates really being partly low, or as we think about labor market recovery, I think a way that I've often been trying to understand the differences in our recoveries to ask, okay, who's able to participate in some of these programs? That was largely the question last year. Who's able to participate in the vaccine and the reopening of the economy, and who's able to participate in that recovery? And I think we really want to recognize that it isn't always an even recovery. But that's really the way that I've tried to couch and ask about the variety of issues that I think you brought up. And that can be international competition issues all the way ranging to fiscal policies, is who's participating in and really having access to these programs, and where can we recognize there might be those differences. So in that sense, it's a lens that I try to have when you think about the number of different indicators. And you said something here right at the end too, is how do we think about it from a macro level versus the ground up? And the one thing that I think is really important to point out is that the Federal Reserve Bank, by having its local presence here in Denver, here in Colorado, is really structured in a way such that we want to hear from you through engagements just like this, to have that grounds up perspective be part of the policy process. So I definitely value the chance to be able to hear some of the challenges that you're facing, the perspectives you have, and how they're unique here in the area. And then we take these and they inform our research, but I think most importantly, they inform the conversation that we have around the policy process. And so it really is, I think, that bottoms-up view that we want to have in the way that we're organized here. So again, thank you for the opportunity to talk with you. If you want to start, I can go through the presentation now, but I think you also had a number of questions that you wanted to begin with, but I can also run through this quickly. Give me just one moment to share.
Run through the presentation, absolutely. Yeah.
All right. So I'm going to share my screen, and give me stand by just one moment here. And so I hope you're all able to see this now. And the one thing that I'll say is my goal here with this presentation is really just to provoke a conversation and for us to be able to have it back and forth. There may be a number of things that you're seeing differently, and I absolutely want to hear those. And there may be a number of the facts and some of the indicators that we monitor that I think you can make real for us and help us understand what that means for you, and I think on a daily basis. So at a high level, let me just give a few themes that I think are broadly reflective of the outlook narrative of what we're seeing overall, and then I want to dive into a bit more details. So we're in a situation where the recovery on the heels of the vaccine, I think, has progressed in a way that has been both very welcome, where we started to see growth pick up. We've seen continued improvement in labor market outcomes. We saw these fiscal stimulus programs either through unemployment insurance and the supplements there, or through the economic stimulus payments that came directly to households. We really saw consumers be in a position to able to spend. I think what's important about that is that even though the data had kind of evolved and these indicators had really attracted the way we thought, it's an important shift in the narrative where just a few months ago, the conversation was largely around how much this PPP, how much those economic stimulus, and how much those unemployment insurance benefits were supporting the economy. Whereas now you see businesses investing, you see consumers able to spend, and it's that private demand, the actual economic fundamentals driving a lot of that recovery. Now, even though we started to see consumer activity pick up, I think we would be remiss to highlight that it hasn't exactly been balanced. We've seen consumer spending grow, but it's grown so much more for goods in a way that is uncharacteristic during normal times, certainly uncharacteristic during economic downturns, where usually you would see services activity either remain stable or pick up a little bit and goods demand come back. And that means a number of things. You mentioned leisure and hospitality, Mike, as one of the sectors that was hit pretty hard, and thankfully we've seen some expansion in the employment there. We've seen the restaurant services and the lodging and entertainment start to pick up again. But I think we're still in a position where we're yet to see services that part of the spending that a typical consumer household, the typical basket that they spend their money on, really still tilted more towards goods. And that tells me that I think we still have some ways to go in terms of normalizing, but it also means that it affects the way that we think about the inflation outlook and the prices that we see, how fast they're growing over time. And I'm going to touch on that a bit. Recruiting workers remains a key challenge for many businesses. I want to talk about this in a pretty granular way here for Colorado, but also for the economy. This means a number of challenges of firms trying to recruit workers, keep their supply lines open. For restaurants, it means seating tables. For hotels, it means being able to book all their floors. And so for manufacturing and retail businesses, it means staffing production lines and even sometimes as much the cash register to be able to sell. So that's creating a number of challenges, but also I think wage pressures are emerging from that. So I think one thing we do want to talk about is the fact that inflation pressures have picked up. Not so much that we want to talk about what's going on today. Even just this week, we started to see some additional indicators come out, but those are backward looking. Those are backwards looking, and they're really comparing what prices are now to what they were in the height of the pandemic. So what I really would like to do is talk about the path going forward. So just as a broad measure, I think it is something that is an overall measure of economic activity. We think about gross domestic product, the overall GDP, all the activity that's going on. We're seeing consumer and business activity supporting that growth rather than some of the fiscal programs, the aid and relief programs that we had. So you see the private sector actually picking up, and the rebound in activity that we saw at the end of last year and the early part of this year, getting into a position where you've offset some of the losses most of the losses that we had last year, and now looking to have the economy grow at a much more even pace over the medium term. But I do want to characterize, I think, the fact the difference between economic activity coming back up to pre-pandemic levels versus normalizing. And those I don't think are necessarily the same thing. So as I look into Colorado here, it's true for much of the rest of the country, in fact, most of the rest of the country. If you get just into March here, just into March, you saw consumer spending get back to pre-pandemic levels. So the zero line here is corresponding to what we had prior to the pandemic. And you see, it really was only just into March, April, and May that we started to see consumer spending in Colorado get back to those pre-pandemic levels and then grow and surpass them at what would be a normal growth trajectory. So while we're certainly welcome to see that activity come back, what we're not seeing yet is a full recovery yet in services consumption. So I'm showing you here the balance between durable goods, so think like RVs, cars, think about computers, the things that phones even, that households tend to spend their money on. If you look at previous downturns, for example, the global financial crisis in 2008, 2009, you see that what is a historical pattern. Usually households tend to pull back on their goods purchases, those durables, and then they actually would keep or maintain their services consumption. We're in a situation, as we know, where services have been hit the hardest because it requires a lot of proximity. So this is things like office and household cleaning services, as well as restaurants and leisure and hospitality. This also includes other health and education services that I think have been hit particularly hard. And so when I think about the recovery, where we are in it, yes, overall GDP and economic activity has returned to levels that we saw prior to the pandemic. Yes, we've seen consumer spending on the heels of those economic stimulus actually being able to spend at levels we saw prior to the pandemic. I still think we're in quite a difference from what we call a normal sense of recovery, and we're still looking for economic trends to revert to some of those norms. As that happens, I think that that has some implications not just for what types of businesses are going to be able to reopen and be supported. I think it has implications for not just the types of workers that we were likely to see being rehired. So like I said, welcome to see that leisure and hospitality and that event space being an important contributor to the very large employment growth that we've seen in the last couple of months. But it also has implication for the prices of goods going forward. And I want to spend a little bit of time talking on what I understand is a bit of a convoluted chart here. But if we look back and we think about inflation rates and we think about what are the driving factors behind inflation, typically we would say that the blue line here, services, note is between 2 and 3% growth on average. We picked the 2004 to 2006 as a reference point here in those dotted lines because that was a time when we had inflation really right near 2%. But this is true going back even further. It's typically what you see is that it's services that are really a driving factor for overall price growth. So this is services which includes the price of housing, includes the price of rent, includes your utilities, it includes the restaurants and the airfares and the hotel travel, the events and entertainment that we go to. That's usually the driving factor behind overall levels of inflation. Whereas you would actually see that goods, there in the green line, is really not much of a contributor. And in fact, and many times because of technology improvements and just how efficient we've become in making things and sourcing things, that you actually see that that's a drag on or at least a net zero contributor to overall inflation. And so when you think about the fact that right now, in just the last couple of months, really goods prices surged as consumer spending on them surged. We had goods prices pick up pretty significantly in a way that has just not been seen over the last 20 to 30 years. And really, I think a reflection of both the supply constraints that have hit some of the goods deliveries. You see that in international prices too in the red. But it's also a fact that consumer demand has really been tilted more towards those goods as we weren't able to convene and get out and be in spaces like restaurants and be in hotels and travel. And so this is one of those things that I expect to normalize in the near term. And I think that that's going to ease some of the readings that we see on overall levels of inflation. And I think naturally start to bring down some of the price growth that we're seeing out there. Now, having said that, I think many of the business leaders here that are on the call that are listening in could probably attest to what they're seeing is the difficulties in sourcing key materials, whether it's coming from abroad or from domestic facilities, is that the supplies of many of those goods, in fact, even in many of those services, are having trouble keeping pace with that demand. And that's meaning to longer delays, as you really see in that green line, or even higher prices that they have to pay in that blue line. And really, the overwhelming majority of firms saying that they're experiencing those bottlenecks, and they're having to deal with them in a way that is creating some cost pressures. So I certainly want to think about what the household is experiencing with regard to inflation. There's good reasons to think that will normalize and start to come back down naturally. But I think you are seeing that businesses and the price pressures and the cost pressures they're facing, there's likely to be some of those pressures, really lasting through some of the midterm before we start to moderate. And as I think about these supply challenges that are there, I think they're very real for businesses. They're having to deal with them on a daily basis. But I also think back to really the disruption that we felt as an economy overall, and instead of dealing with some of the disruptions and pressures in the course of just 1 to 2 months, we're really seeing those bottlenecks being spread out over this year and a half. And so we're just seeing the tail ends of that, but some of those disruptions are likely to fade coming in. Now that's business side and households. We're thinking about consumer demand and where it's sitting there. But one thing I think we want to look at is the other side of this, besides businesses and consumers, is the labor market. We saw a sharp decline in overall unemployment, the fastest decline in unemployment that we've seen during an economic downturn or following an economic downturn in recorded history. I think to the point that was largely attributable to the incredible fiscal stimulus that was out there. Mike, you talked about PPP and that initial SBA program that really supplied lending on the stipulation that businesses were able to keep their employees and keep their labor force attached to their business. And I think you see an incredible power in that, in having the fastest decline in overall in the unemployment rate that we've had on record. For example, if you look at the left-hand side of this chart from 2010 to 2020, coming off of what was previously the biggest rate of joblessness that we had seen in almost a century, how gradual the decline in unemployment had typically been. And so I think you did see that sharp reduction. That said, we're still seeing some disparities in the rate of recovery, and in particular, Black and Hispanic workers are still facing relatively elevated levels of joblessness. So I think there's still some recovery, some job gains to be had for certain segments of the population. Certainly the Hispanic population is part of that. Now, the unemployment rate remains somewhat elevated. We still have a couple, several million jobs that are not yet filled relative to where we were prior to the pandemic. And if you ask firms about the difficulty of hiring, why are they unable to hire or able to expand their hiring plans? When we really ask what those factors are, the blue indicates the first or most important factor here. What you see is the overwhelming majority of firms that are surveyed here in our region, including firms in Colorado, as they tell us they can't find workers with the required skills. And I think that's an interesting challenge, given what was shown in the last chart, is how do we have a certain number of workers that are still looking for jobs, but also having challenges of actually finding workers with the required skills to actually do the job. And so many firms saying that that's such a problem to deal with these types of labor shortages. And I would bet that many of you on the call have specific experiences with this that I would love to hear. Well, one of the other things that happened wasn't just the rate of joblessness, but we saw people last year who had lost their job, and many of them actually left the labor force. They were concerned about contagion risk, and I think that was a challenge. They were concerned about catching the virus and bringing it home, especially if you had a multi-generational home, where bringing it home could be a much more severe consequence than if you were a young person living alone. We saw that there were significant challenges in actually providing for childcare and managing working from home, and that created a difficulty for people to be able to supply their workers. We also perhaps saw some disincentives that came from unemployment insurance that started to linger. This was certainly an important policy when you had workers that were didn't have the opportunities to be able to go and look for work because of the virus. But now we're starting to see some of those pressures abate. And so really it was this participation issue as much as the jobs issue, saying who had left the labor force and what was that doing to the prospects for recovery. And I think we see something pretty interesting here in the last couple of months. It was a development there, which is certainly following January 2020, that decline in participation, 4 or 5% of the labor force. So I know these look like relatively modest changes, from 100, down to say 97%, just as a relative there. A 3 to 5% drop may not seem like a lot, but you're talking millions of workers at that point in time. But what you see now as the recovery started to progress, and really this past several months where the recovery's picked up in earnest, is who's coming back into the labor force seeking work and engaging those new opportunities. You've seen Hispanic and other minority workers actually come back and are very close to being participating at the levels that we saw prior to the pandemic. In fact, nationwide, just a couple 100,000 fewer as compared to white individuals, where we're still about 3 million workers short of where we were prior to the pandemic. So yes, I think we see the rate of joblessness as being elevated for minority workers, but we also see that participation, that engagement in the labor force, that looking for work and opportunities actually starting to pick up. Now, alongside this, we've also seen a pickup in small business activity here in the last couple of months, which really hadn't been happening. And so happy to see that re-engagement from both small business and from minority workers here.
Nick, for a moment, can you talk a little bit just about the, I'd like you to delve in maybe a little bit deeper in terms of labor force participation in regard to gender. And that, some of the data that I've seen is that, on one side, we've seen like 25 years of progress kind of almost rolled back in terms of, female labor force participation in 1 year.
Right.
I mean, if those are obviously other indicators, but I think we saw a mass exodus, in a lot of different ways. And I think that, for some of the different factors that you talked about, has made it more challenging, for them to go back into the workforce. And I think childcare is a big one. I think the instability in terms of the, like our educational systems. Are the kids going to be in school? Are they going to be quarantined?
Right.
Not being dependent upon childcare. There's a lot of, discussion about how our childcare system is broken in Colorado. We struggled to begin with. But can you talk a little bit more about that from a lens of like gender and, and then also too, when I think as well about gender, I also think about the wage gap, between gender and specifically even Latina, which is the lowest out of all the women. And I believe pre-pandemic, that was at 55 cents on the dollar, and how that now is maybe affecting everything. I
think that's right. And I'll just say, I think this is the right discussion. I'm glad you pushed it, you pressed to ask more about this, because we often would talk about an economic recovery in terms of what's consumption activity doing, and what's business investment doing, and really that private sector, and then really what's unemployment rate. And I think what we've learned is that the labor markets, the choices that households and the challenges that households face are not necessarily affecting which job to take, or are they getting enough job, but do they actually seek and participate in the labor force at all? That's a much more profound challenge, because it can really be a drag in overall economic activity. It's a much more profound challenge because working or not can mean so much for the livelihood of households over the course of their career. And it often involves a number of personal considerations. So I think this is something that we do want to focus on. And to your point, this was a recession. This was a shock to our economy. This was a challenge that we faced that was disproportionately borne by women. And that you saw that as a market decline in the participation rate, certainly for women, that exceeded that level of men. It was something that disproportionately affected women who were near child rearing ages. So you started to see the pullback. That's unfortunate, because the child rearing ages are also the same ages where you tend to see the most wage growth, the most career growth, where you start to see that re-engagement of economic opportunity. So I think it is a significant challenge. To your point, I think childcare was one of them, that even when there were decisions that were made about childcare, there wasn't certainty in whether or not those decisions were going to be persistent. Yeah. And so I think that we do see a little bit different prospects for some certainty this year. And let me try to highlight what I mean by that. Is last year there were decisions that were made by public school systems. They were varying quite a bit. They were varying based on contagious rates. We just learned so much more about childhood contagion, the spreading of the disease, and the risks that actually they face. And the CDC recently came out and made a recommendation now that schools could and should reopen, that recognizing that those transmission rates were much lower and the cases were less severe for children than they had actually thought. And so the second part is we learned about the efficacy of the vaccines, of actually slowing and really suppressing hospitalizations, even if not suppressing full transmission completely. And so as we learned about those things, I think you're hearing policymakers, and this is really outside my scope, but what I'm listening to some of the same things you might be, is that they now have recommendations from public health officials. We now have information that we didn't have last year to be able to make decisions with a little bit more certainty and credibility. And so you're seeing those recommendations start to play out. Again, the service sector, which has been hit particularly hard, also includes childcare and healthcare and some other educational services. I think you're seeing the employment start to come back there, which to me is an indicator that those businesses are opening. They're available and taking children and providing that service again, which was just difficult to find last year. And so for the persistent challenge that we had of women having to leave the labor force, disproportionately bearing the burden of caring for a household with children, I think was, we're in a different situation now with a little bit more certainty out there. You also talked about the wage growth issue, and I'm glad to have that. As you think about what are the factors that really encourage that participation to come back, we have seen that women are much more responsive to wage growth than are men in terms of prompting that decision to be able to participate. Unfortunately, what we have seen is wage growth, even at low skill and middle skill levels, where you've seen that wage growth actually start to pick up, meaning the opportunity to be able to actively engage in the labor force and maybe offset some of the opportunity costs of having to pay for childcare is actually there. And so difficult last year, but I think we do have some better prospects for women and others to be able to re-engage in the labor force going forward.
Okay. So what I hear you're saying is that you're expecting a greater amount of almost like institutional stability. One, with the fall, every school will be open. Two, I think we're seeing a greater amount of capacity, within, let's say, options for childcare camps after school, because I think that was a big challenge too. Yeah. Even with this summer, I've got 3 kids that are downstairs at the moment that I think before this you saw, between the ages of 4 and 13, and it's it's dad's summer camp, right? I mean, so it precludes me from participating, in an office-based environment, but I have the luxury of being able to go through and do a job from home. So. And I think too that you're right. We're talking about the the CDC recommendations, and I believe there's an expectation that the vaccines will be available for 6 to 12-year-olds, late August, early September, right in time for school, and that should hopefully provide, you're right, a little bit more of a comfortability in terms of, let's say, options and stability in terms of knowing that if you do go back to the workforce, you're not going to have to exit, immediately for a 2-week, quarantine. The other thing I wanted to know if you had seen is McKinsey came out with a report maybe about a month or 2 ago, and they had a part of it is that they had like all the major metropolitan areas, but it was an economic opportunity score, and that Denver was ranked dead last in regard to Latinos. And did you see that by any chance?
No, I hadn't seen that. If you I passed that along, but I'd be interested to see when you think about the opportunities that are there, what are the factors that we want to be aware of? Because this goes to the participation in the recovery, what that means, the banking system or small business or labor market. I'd be really interested to hear what that.
And I think it's an important piece, and I'd love to be able to go through and get you the full data report and maybe even have a smaller discussion, in a couple of weeks just about that. And thinking about what that really means and what is that saying, and what do we do with that? Because I think that's always very interesting considering all the research that McKinsey has done over the last year, in regard to equity and in regard to, this idea of recovery, to actually have Denver, come out as dead last in regard to Latinos. And when you look at the data and the plot graphs, it's even worse than I'm describing. But yeah, with that, I definitely would love you to continue on with your presentation as well.
Actually, you caught me right at the end. I think that the one thing that I just wanted to close with is where we are, is to say, as we still look at participation, that willingness to come back to work, lagging for women, lagging for some other groups, as we're seeing small businesses in particular really only just starting to be able to be part of that recovery. I think we're in a position now where policy support on the fiscal side is starting to come back, but that policies, low interest rates, that encouraging for borrowing and access to capital for small businesses is still there, and it's likely to remain in place at least until we continue to see further and substantial improvement in some of those outcomes. So I think that's also just the stability in that policy environment is where I think we are going forward. Now, the best thing that I think we can do for informing that policy process and that deliberations is really how solid a footing are our workers on? How solid a footing do our businesses seem to have? Is really not coming from any of the indicators that we come to track, because that's your perspectives going forward. And so really the last point I wanted to say is, what type of support do you guys still you see for all of those watching? What type of support do they still, I think, look for? Is it whether it's greater certainty or adjustments in other types of programs to be able to support that recovery going forward and really enhance that participation more broadly. So happy to take any questions, comments, suggestions, or pushes on that.
No, absolutely. And I think one of the things to think about is that, and I can speak to, Denver Metro and Colorado, but obviously I'm in constant conversation with, a lot of my other colleagues throughout the country. And it does seem like there's a little bit of a disconnect in terms of really understanding the size of the Hispanic community. So in Denver and in Colorado, 70% of the minority population is Hispanic, right? Yes. Denver, 70% is Hispanic. Denver metro area, 70% is Hispanic, right? And when we think about Denver alone, 1 out of 3 residents is Hispanic. And we think about which way the wind is blowing, 58% of Denver public school enrollment is Hispanic. 60% of Aurora public school enrollment is Hispanic. So we do see a great amount of growth, in terms of being able to go through and kind of connect the dots within our, our local and state economy. That a substantial amount of everybody's future workforce will be Hispanic. A substantial amount of everybody's future consumer will be Hispanic. We have over 120,000 Hispanic-owned businesses in the state. And so with that, but part of it's a disconnect in looking at this as purely monolithic. So one, that is a great amount of diversity, between language, between levels of acculturation and assimilation. There are over 30 countries of origin, the majority being Mexico. However, there's a great amount of also geographical, let's say disbursement throughout the metro area and the Front Range in the state, differences in gender and age and language and immigration status. So thinking about all those, it's not one monolithic, it's really kind of understanding the segmentation, and some have done really well. Others have done extremely poorly. So I think any data that I would encourage that you look at, or let's say end up going through and collecting in the future, that you look at the very least of being able to go through and kind of account for level of assimilation or acculturation. And I think without doing that, you end up with very skewed data, because it's easier to get assimilated, than it is to be non-assimilated. So, and when you think about, this, like, let's say, platform of assimilation and acculturation, I think about it in 5 different buckets. Let's say on the far left is a dominant English speaking Hispanic, that is 3rd, 4th, 5th generation. On the far right is dominant Spanish speaking Hispanic, 1st generation. And then in between are 3 different levels. And so when we look at this, part of it's just getting an idea from a state perspective. When we think about 1.2 million plus, how many people are in each bucket that we're estimating? And then when we go through and collect sample sizes, do we need to upweight or downweight based upon responses we're getting? The other thing is that Hispanics are overwhelmingly positive, considering the general population when they are responding to different types of studies and polls or questions, and the less assimilated you get, so the more dominant Spanish you get, the more positive they get, okay? So, that are just 2 little factors. And kind of when we look at this stuff, it's, part of it's a data point. But that even makes it a little bit more concerning about that McKinsey information, is saying, okay, when we look at this, and this is pretty known for people that do a lot of research within the Latino and Hispanic communities, that we're seeing that such a low number on that side. But I think part of the challenge has been, is it's just been tough. Like, one, identifying, when we think about the term equity and the word equity, do we really know what it means? Does everybody really know what it means? Are we really understanding the difference between equity and inclusivity? And if we have inclusivity without equity, is that inherently unequitable?
That's right. And one thing you've talked about, data and studies and things, and one thing I do want to point out, that the way that I try to think about this is before we get to data and studies and things, I think it starts with conversations like this of helping us to identify, hey, how should we calibrate and tune our ear when we think about a community that makes up such a significant part of our region. How do we tune our ear to really understand the differences in those economic challenges they might be facing, or their ability to participate? So I actually would say first I start with these conversations that I hope would be ongoing, is to help tune our ear and give us a lens to help to understand that. So I think you're absolutely right that thinking about any community as a monolith, or any industry for that matter, or segment of the population, I think that's a significant oversight, because you really can see economic shocks hit folks in an uneven way, and frankly, it's not going to be a lot of the data that's going to pick any of that up, because the ways that we try to measure data are so coded and often outdated and backward looking, that really it's a direct conversation that we can have that help us to understand those challenges. So I really hope we can have that frequent conversation to help us view it that way.
No, and I think that's an important. And and as I kind of think through, it's just and then part of it is as well as thinking through, and we think about the businesses and their role within the the economy. I think just in terms of like playing with fun numbers right now, when we think about 29% of the state's population is minority, right? I think that's an easy number to agree upon. That minority populations also are much more entrepreneurial, and the more like immigrant-based, Asian, African immigrant, Hispanic immigrant based you get, the higher, the percentage of entrepreneurism, and it's not about, the Denver Startup Week, let's kind of roll the dice and see if we can go through and create a tech company and sell it for $50 million. It's about survival, and it's about creating economic opportunity, in a generational perspective for your family and achieving the American dream. Now, with that too, I think is a really important piece that if we think we have, once again, at the very least, on par with the rest of the public, which would put us at about 30% of the small businesses, but really it is a higher percentage considering, the attraction to entrepreneurism, in regard to economic opportunity. But we also think of the disconnect in terms of the challenges in terms of accessing capital, right? Yep. And then it's not only the challenges in accessing capital from an underwriting perspective, in traditional bank or CDFI, but it's also this recovery process, right? And it's programs, that may be built for a different business. I'll give you an example, that on paper, it may look like a great way to identify, let's say recovery dollars or grant dollars going into minority-owned businesses is saying, if we have a rubric and we're going to weight higher if they have high interest debt, okay, from, whether it's credit cards or it's, some of the payday, almost the payday loan kind of business loans, that we've seen kind of circulate with 20%, 30% interest, shorter terms, and absolutely there's a market for those. And I mean, they're preying upon somebody. And there's a lot of credit card debt being carried basically to support businesses, and so that would initially be a good indicator to be able to go through and say, all right, how do we really target these businesses in a non, ethnicity or non-racial way, right? However, when you think about the Asian, entrepreneurial community, and specifically the immigrant side, or you think about the Latino immigrant business community, they're not borrowing money in traditional ways. A lot of the lending is coming from within the community. So they aren't using a lot of credit cards. They don't have the formal banking relationships. They are not going through, they're borrowing money from their uncle. They're borrowing money from their family, so it's a little bit different. So we don't have that necessarily that indicator. In addition to that, it's really kind of thinking about how do we create some different models temporarily to be able to go through and really engage, because we're dependent upon whether a business has a relationship with a bank or even later on, with the CDFI, or some other type of basically, community lending organization, right? But I think that is where sometimes we take it for granted and assume that they all have these great relationships because it's a CDFI. That is not the case though. Right? They're going to have their own relationships. They have their own implicit and explicit bias. And I think too, when we think about some of these grant programs and about the factors that we account for, which is business stability or business sustainability, once again, we have a really big challenge and potential blind spot in this X factor of subjectivity that can, that can, be subject to like implicit and explicit bias. If you don't know, right, the community and what really works within this specific community, you may not rate this business as viable, right, or sustainable.
Yeah, and I think that you're highlighting, I think, again, I go back to it I appreciate the lens. The challenge on that is you're right, is the traditional, like the metrics and data, we think of them being out there, they're tracking what you know. Yeah. And what's the real challenge is to be aware of what you don't know and in the community. And I think that really the best way to absolve yourself of that sort of implicit bias is really these conversations to help us understand that things work a little bit differently. Those anecdotes tell us, I think, give us that right lens to understand what are the challenges that we don't measure. Yeah. And when you come to access to capital, I think that's really an important one, because when you think of the Federal Reserve and the main policy tool we have is really trying to encourage access to capital to help businesses get going. That works when you lower rates and for those that are borrowing traditionally, and hopefully it transmits to other parts of the economy. It's not as effective as transmitting to those that aren't necessarily participating in more traditional bank lending environments. And so that's a really important way to calibrate how effective is the tool that we have at supporting the participation in the recovery. So I think you're right on to highlight this, and I appreciate that perspective. Some of it is not just the relief programs, but I think what you're talking about is, besides the relief programs for getting through the pandemic, and besides some of the recovery programs that are really targeted at economic development to help folks get their feet underneath, I think this is a more persistent challenge is over the longer term, even as the private economy really starts going, and you really see businesses having those relationships they want to have with their lenders, whether it be a bank or a CDFI or some others. Again, is consistently measuring who's able to participate, because to the extent that financial access, financial constraints is a real factor driving the business, I think that's something we need to be aware of, and it needs to be part of the conversation of how effective is the tool that we have out there at reaching part of their community. I think you're absolutely right.
No, and I think that you're absolutely correct. I think pre-pandemic, we knew there were challenges beforehand, right? Yep. Now, I think we've had a year and a half to be able to go through and think about, this is the best case study we could have had. Like, we're having challenges giving away money, right? Yep. And so if we're still having challenges giving away money, we understand that not only do we have inherent problems in terms of the system and the way, like there is a disconnect, right? And part of it is being able to go through and think about, the forward-facing opportunities in terms of being able to create these additional relationships, and making sure that there's enough like perceived value, or this perception of value within these communities, understanding how big they are. So I think that's one thing, right? That maybe we need to generate more demand from the traditional commercial banking side to really take a look at this and future as growth. And the other side is saying, like, do we need to reevaluate this idea of like how they're determining risk? Right. So with this underwriting, is that itself, right, outdated and not looking at the right factors, to really determine exactly viability in this different sense? So I think there's a couple of different elements, but I think this does present a unique opportunity for us to rethink this in a little bit of a different way, especially when, holding somebody's hand to be able to go through and let them access a PPP loan, which is guaranteed by the federal government, or, there's all these other like lower interest loan products now coming out, that the Climate Fund from the states, the Energized Colorado Gap Fund, there's a loan product, that are really like the risk is really underwritten by the organization or by the state. So I think it's a great opportunity too, to be able to think about, these new relationships that can be handled, especially when, your risk model has been dramatically, altered.
Yeah, I appreciate. I think what you're coming to is something that we try to talk about here quite often, which is building a shared perspective, even when they have different, even when they're coming from different places, and that requires, I think, understanding, how we hear some of the economic challenges or the economic circumstances of a potential borrower or potential lender, how we hear that those circumstances can really differ, I think, for folks. And yes, I think, we want to be cognizant of that. And again, I just go back to it. I appreciate the opportunity to hear from you, because it starts with conversations like this. And it really takes an ongoing conversation like this to be able to share that perspective. One thing that I'll just, in closing, we'll talk about is not just the financial side, that access to capital issue, but it's really, what are the targets that we want to go, what is it, what is considered a good outcome? And you mentioned McKinsey say, I really want to understand, why is that a negative outcome? What are those factors? And I think what does shared success look like? What does uneven or even recovery or participation look like? And we have seen, I think, some developments in that standpoint, even from the Federal Reserve's perspective. Is last year we really had a monetary policy strategy, not for the pandemic, but overall, which was targeting this maximum employment and this notion of it's kind of a level of employment that we thought was broadly shared among others. And there was an explicit, I think, recognition from the Federal Reserve through a variety of Fed Listens events, hearing from folks about what maximum employment or successful employment outcomes look like. And in response to that was a shift towards a different stance of labor market success that was much more broad in its outcome, not just along race and ethnicity, but across, I think, even income levels and participation. So when you start to see that type of shift, is you're right, it's a part of that conversation that you see manifesting in how policy is actually conducted, how the committee actually thinks about conducting policies, really to be broad-based and much more inclusive in the way that we see successful outcomes. So a bit of a difference there. But I think you're right. This is a conversation that impacts not just our monetary policy, it impacts the way that we think about the relationships that lenders have with their borrowers. And frankly, it impacts the way that we as a community interact with one another when we're not talking just about policies. It's just being out there together.
Well, Nick, listen, I really appreciate the time you took today, and I look forward to, let's get back together in a couple weeks, and I think have another conversation with our board. And I think we're going to get a lot of questions about this, but I really appreciate the time, the intentionality of being able to go through and look at this from a micro level and a macro level, and we'll look forward to the next conversation. So thank you.
All right, let's keep it going. So thank you very much, Mike. Appreciate the opportunity.
Thank you.